The Reserve Bank of India today cut the interest rates by 50 basis points, which has implications both on your borrowings and investments. Let's understand how. Yes, definitely. Most of the banks and housing finance companies will look to bring their rates down over the next week or so because they risk losing customers like you. If they don't bring the rates as much as what SBI has brought it down to, they will look to come as close as possible to SBI's offering. We have to break down into two parts, first for new customers and then for the existing customers. So for new customers, definitely yes, the rates will come down in the same proportion as the bank or housing finance company reduces its benchmark lending rate. So for example, if SBI has reduced its lending rate by 40 basis points, then your EMI will come down in the same proportion. For an existing customer though, there are two scenarios. If the bank had initially raised your tenure when the rates were going up, then you will first see a reduction in your tenure and then maybe later if the rates really go down, then you may see a cut in your EMIs. But you need to understand that for an existing customer, the benefits are not in the same proportion as they are for the new customer. Not necessarily. I mean, for a customer, suppose you are an old customer and you are paying around 10.75%, but a new customer is being offered 9.6% or 9.8% by your own bank or housing finance company. You may go to your own bank and ask them to switch over your loan to the rate that is being offered to a new customer. So for which you'll need to pay around 50 basis points as switchover fee on the principal outstanding. You may also go to a new bank if the deal is more enticing and they are offering you a better loan than what your bank is offering to new customers. I think the time has not come for that yet because we are on an interest rate cut cycle, and unless you are really sure that the rate cut cycle has bottomed out, you should not make that attempt, because you have a lot to benefit if the rates keep going down. If you're paying a really high interest rate, if you had locked yourself in a fixed rate when the rates were at around 11 or 12%, and now the floating rate loans are around 9.8, 9.9%, with the prospect of it going further down, you should definitely look to take that call. You should ideally look to defer it for a week or two, because by that time you will have a clear scenario of which bank is offering what and how much they have reduced their rates. So you can do the comparison in a week's time or two, and then look to go ahead with a bank or housing finance company that you are comfortable with and that is offering a better rate. If you are looking to do an FD, then do it right now, because with rates going down, the first thing that the banks do is to cut on the deposit rates, and so your best prospect is to get locked into a rate that is being offered now, because that is set to go down. The cut in rates definitely makes fixed deposits less attractive, but you certainly can't compare the returns with the equity returns. If you're looking for other options on the fixed deposit front, then in fact fixed interest rate front, then you can go for PPFs that are offering 8.7% currently. However, the catch is that you'll have to lock yourself in for a longer duration. Other options on the fixed investment side are debt mutual funds, which have traditionally offered higher return than fixed deposits. And also you can look at tax-free bonds that the government had announced in the budget, and NTPC recently came out, but there are more to come going forward. So you may look, but you don't know how much you can get, because there's a rush for it once it comes.